So since I'll wrap up, and since this is so risky, such a risky investment, and I would suggest, okay, for financial institution to sell this kind of product to investor, okay, they need to make sure, okay, this investor know the risk, and I would even suggest the government may put up a regulation to ensure the institution can sell this structured product to investor only when they pass a certain proficiency test, just like you need a driver license to drive. So for regular investor, you need a certificate for you to invest in this kind of structured product.
Hi, good morning, everyone. My name is Buensin. I think my focus is slightly different from the other speakers. My focus will be on Singapore banks and Singapore situations. I guess this crisis is a credit crisis that eventually lead to a liquidity crisis. In this type of situations, any bank want to survive in this type of situations have to be very strong in three aspects: a strong capital base, a large deposit base, and a prudent risk management policies. I think Singapore banks score well in all these three areas. Capital base. Basel's Accords has set a minimum standard for capital adequacy ratio at 8%. MAS, as a very conservative and prudent central bank, has set it at 10%. And our banks, for financial year 2007, they have 13.6% ratios on average. And before this crisis hit us, that's really September is really the major crisis hit us, they have collectively raised about 5.3 billion Sing dollar of Tier 1 capital. That has raised their capital ratio to about 15.2. So it's way ahead of the minimum standards. So we are very strong there. Large deposit base. We are wealth management centers. So naturally, we have very large deposit base. I think the loan to deposit ratio on average is about 81% for our local banks. So we are quite safe there. We do not need to rely on the very high risk and sensitive interbank loans, which a lot of these investment banks got themselves into troubles. Prudent risk management policies. Our non-performing loan ratio is about 1.53% on average. And we are known for very conservative in our risk management and very prudent. And in fact, a lot of analysts, when they analyze Singapore Bank, they will say that they are too conservative. And this is a time where these characteristics really stand out. So as a whole, we are okay. How about toxic assets? Do we have direct exposure to these toxic assets that originated in the States? MAS has told us there's no subprime loans, direct exposure to subprime loans, but we do have exposure to CDOs. I think the last figure of the second quarter of 2008 is about 1.58 billion. Collectively. Some banks have higher exposure, some have very little exposures. Compared to the capital base, this is really nothing. But we're going to expect some more write-off from there. How about those exposure to laymen? All banks have come out and assures us that its direct exposure is insignificant. And how about moving forward in the futures? I think major central banks have come out to guarantee interbank loans. Today, well, as we jokingly always say, there's no more bank risk. It's all sovereign risk. We're all lending money to the central banks, not to the banks. So I don't think the situation is going to deteriorate. So we are quite okay here. I mean, the next question a lot of people come to mind is, why MAS are guarantee all deposit if we are okay? I guess we have to look at it in two perspectives. Firstly, the guarantee is not only on Singapore local bank. It's actually for all banks that are operating in Singapore for Sing dollar and foreign currencies. Well, the second aspect is that this is actually to level the playing fields. We understand Singapore is a wealth management center, and we are competing with a lot of nations in Asia for wealth management business. If MAS is not going to do this, we can expect that the wealth management industry in the next 2 years is going to have a lot of stress. How to retain the funds in Singapore and how to attract new funds here. So I guess this is for competitive reasons. We have no choice to do it. But I'd like to give a word of warning here that they may have some unintended consequences, that we may change the risk behavior in the futures. Because if we are doing this, to some extent, it's a punish the good bank measures. Why? You imagine the situation where we have a prudent bank and non-prudent bank. This is a situation, times where prudent bank really stand out and differentiate them. Prudent bank in this scenario is the asset quality is going to deteriorate substantially. And the cost of borrowing is going to go up, and the deposit is going to flight to quality and move to the prudent banks. And the prudent bank asset quality is going to be maintained, and the cost of borrowing is going to stay low because fund is moving in. But now, all the central bank in the world guarantee the deposits. If you are depositors, you are now basically not lending to the bank. You are putting money with central bank now. Where you go to? The one who pay you the higher interest rates. And the poor prudent banks, which at this time supposed to have a low cost of fund and doing better, now they have no choice but to raise their cost of borrowing because the not prudent bank is keeping the interest rate high and probably even raise the interest rates. Think about the long-term consequences in terms of the risk behaviors. But having said all this, let me say that I'm not saying this is wrong policies. I think this is a very important policy today. As one of my colleagues have nicely put it, the patient now is suffering from major heart attacks. I think this is the last thing we want to talk about is how to control your cholesterol levels. So it's very important that we save the hearts now. Okay, thank you.
Thank you. Good morning. I'm Ki Gyap from Nanyang Business School, Banking and Finance Division. I have 5 points to make for 5 minutes. Now, the first point I'd like to make is this, that I think the financial markets will continue on with the roller coaster, at least till the end of the year, simply because that although they are already guaranteed on interbank bank lending in the money market, but I think the money market, both in Europe and US, are not functioning normally yet. And also, although there are big promises of injection of capital to the banks, but I think the details are yet to be fixed. So until we see concrete actions put those banks and money market into operation, the roller coaster will continue, and therefore I think dealer as usual will continue to trade on the market. And for Singapore, I think the market also will continue to be volatile. The fact that the government has stopped the deferred payment has allowed the property bubbles to ease even before this September. So I think that is why we are seeing slightly less volatility, but I think the market will continue to be weak. Now, the second point I want to make is this: for 2008, our GDP growth, I don't think we are going to make it at 3%, although that is on the lower end. And for 2009, we're looking at zero growth for the whole year. And simply, we think that the recovery this time, unlike in the past, will not be V-shaped, but it will be U-shaped. And although we have made tremendous effort in diversifying our economies into various sectors, especially services sectors and manufacturing sector, we also have diversified. But this time, although we have diversified our economies, but major market, Europe and US, basically are not doing very well, and I think this is what is making our recovery difficult. And also, I personally would like to believe that the integrated resorts, which initially supposed to be in operation in the third quarter of 2009, I don't think both integrated resorts can make it by 2009, and at best, they will be able to only operate in 2010 after second quarter. So that is why I think the economy outlook will continue to be weak, and the recovery will be, for the first time, unlike in the past, it will not be V-shaped, it will be U-shaped.